The average American household pays somewhere between $8,000 and $14,000 in interest every single year. More than groceries, more than clothing, often more than healthcare. And most of them couldn't explain exactly how that number got so high. By the end of this video, you'll know precisely how interest works on every major type of debt. Credit cards, mortgages, auto loans, the works. And you'll know one move that can save you tens of thousands of dollars without refinancing, without a side hustle, and without changing your lifestyle at all. And the third thing I'm going to share, banks are specifically counting on you never figuring it out. So sit back, grab something to drink, and let's get into it. Here's what most people miss. Interest isn't one thing. It's 6 different things, disguised as one. And the version your credit card uses is specifically designed to be the most expensive version possible. Your credit card APR, let's say 22%, right around the national average in 2026, doesn't get charged once a year. It gets divided by 365 and charged every single day. That's the daily periodic rate. On an $8,000 balance, that's $4.82 in interest today. And tomorrow, and the day after that, including weekends, including the day you make a payment. Sarah, a kindergarten teacher in Columbus, lived this for 3 years. She'd put $6,200 on her credit card, a car repair, then groceries, then keeping the lights on through a rough stretch. She made payments every month, $62, sometimes more. By year 3, she pulled up her account and did the math on her phone. She'd paid over $2,000 and her balance had dropped from $6,200 to $5,900. I felt like I'd been robbed, she said. But the weird part was, I was the one who signed up for it. The minimum payment isn't a suggestion. It's the least the bank will accept. On an $8,000 balance at 22%, paying only the minimum keeps you in debt for approximately 27 years and costs you $15,300 in interest, nearly double what you borrowed. Add just $100 extra per month, you're out in 6 years. 200 extra, 3.5 years, $2,800 in interest. The math responds fast. Every month you wait is $4.82 you don't get back. All right, so that's credit cards. But what about the biggest debt most people carry? Your mortgage. And here's where it gets interesting. Because the way mortgages are structured is one of the most counterintuitive things in personal finance. It's called amortization. Every monthly payment is the same dollar amount, but what's inside that payment shifts dramatically over time. On a $400,000 home at 6.75%, right in the range for 2026, your monthly payment is about $2,594. In month 1, $2,250 of that goes to interest. Only $344 reduces what you actually owe. Think about that. 87 cents of every dollar in that first payment goes to the bank, not to your equity, to interest. The Garcias in Phoenix bought a $380,000 home in 2019. By 2024, they'd made 5 years of payments, $111,000 sent in. They assumed they'd significantly paid down the loan. Their mortgage statement showed the balance had only dropped from $380 to $345. They'd paid $111,000 to own $35,000 more of their home. The other $76,000? Interest. The husband described seeing that number for the first time. I thought owning a home was building wealth. I didn't realize that for the first decade, you're mostly just paying for the privilege of the loan. But here's the turn. They discovered that adding just $300 a month to their principal payment would shave 8 years and $85,000 off the loan. No refinancing, no closing costs, one habit change. Here's an even simpler version. Make one extra mortgage payment per year. Just one. On a typical loan, that alone cuts a 30-year mortgage down to about 25 years and saves $80,000 to $100,000 in total interest. Your amortization schedule, the document that breaks this down payment by payment, came with your closing paperwork. It's probably in a drawer somewhere. It might be the most important piece of paper in your house. If this is clicking for you, hit subscribe. I put out videos like this every week. And stick around, because the best one is coming up next. Okay, remember how I said banks are counting on you not knowing one particular thing? Here it is, deferred interest. And if you've ever used medical financing, retail installment plans, or certain store cards, there's a real chance this has already happened to you. It looks like free money. That's the trap. Here's how it works. You finance something, a dental procedure, a veterinary emergency, a new couch, with a promotional offer. 0% interest for 18 months. You make your payments every month. You're being responsible. You feel good about it. But here's what the fine print says. If you don't pay the balance to exactly zero before the promotional period ends, every dollar of interest that would have accrued during those 18 months gets charged to your account. All at once, retroactively, on the original balance. Linda in Des Moines learned this the hard way. Her dog needed emergency surgery in 2023, $4,800. The vet's office offered care credit, 0% for 18 months. She made $200 payments every month. By month 17, she had $400 left. She was nearly done. Month 18, her statement arrived. Her balance was $2,214. 18 months of interest at 26.99% on the original $4,800, charged all at once because she hadn't reached zero. I was doing everything right, she said. I was making payments every month, and then the bill came and I just started crying. This isn't 0% interest. It's deferred interest. Postponed, waiting, accumulating silently the entire time. The Federal Trade Commission sued Care Credit's original issuer over this practice and reached a $34.1 million settlement. The practice continues legally today, with disclosures that almost nobody reads because they're signing paperwork in a vet's office right after being told their dog needs surgery. The rule is simple. If you use promotional financing, set a payment that gets you to zero at least 1 month before the promotional period ends. Not the last month. 1 month before. Put that end date in your calendar right now. Treat it like a deadline, because it is. So there you go. 3 ways interest works that most people have never had clearly explained. The daily compounding trap on credit cards, designed to keep you paying for decades. The front-loaded amortization on mortgages that means your first years of payments are mostly a fee for borrowing. And the deferred interest ambush hiding inside promotional 0% offers. The one that punishes you for almost getting it right. The minimum payment is designed to keep you paying as long as possible. The amortization schedule is designed to pay the bank first. And the 0% offer is designed to look like a favor right up until the moment it isn't. None of this is illegal, but the system was never designed to explain itself to you. Now it has, and that changes everything. If this video helped, share it with someone who needs to hear it. And subscribe. Next week, we're getting into exactly how to rebuild your credit score faster than you think is possible.